Assets versus liability. Most people believe they own many assets because of what their financial advisors, whether that be their CPA or parents in life, has told them. What is an asset versus liability? Asset. Resources owned by a company or person which have future economic value that can be measured and can be expressed in dollars. Examples include cash, investments, accounts receivable, inventory, supplies, land, buildings, equipment, and vehicles. Most people believe that all these things are assets because of what school and accountants have told us. But the richest people in the world would not consider most of these things assets. Many of the rich only consider assets as anything that puts money in your pockets. Let's take a deep dive into every single one in detail. Cash. Are you earning interest on the cash you have? Is it a stream of income? Or does it just sit in your wallet or checking account with no interest? If you don't gain anything from your cash on hand, then it's more of a liability than it is an asset, since cash depreciates due to inflation. Investments. Stocks, bonds, mutual funds are assets, as most people will gain returns annually or possibly quarterly if they own dividends in the company, based off company profits. Accounts receivables. Money owed to a company by its customers or clients. You can count it as an asset as it is money that you should eventually get as long as that customer client doesn't default on the loan. Inventory is a tricky situation. Can you sell it fast enough before it depreciates or perishes, depending on what type of inventory you own? For example, if you are a small convenience shop that always throws away milk, meat, bread, and it costs you more money to keep it than it does for you not to sell it, then it's more of a liability than an asset. Land can be subjective. Is it bringing you money? Are you growing crops or raising farm animals to sell for profit? Or do you just have 100 acres of raw land that you use to hunt on for leisure, costing you money? So it actually just costs you $2,000 a month to operate with no returns until you sell it off for capital gains. Buildings. Are they costing you more money than it brings you? When you buy a home, does it cost you $1,000 to $2,000 monthly? If it does, then it's not an asset. If you buy, say, a fourplex, live in one unit, and rent out the other 3 units, and it brings you $500 monthly, you can count it as an asset. Equipment. Does your machine cost you more money than it makes you? Say you buy a coffee machine and you don't actually sell coffee, or you just give it away for free to your customers. Then it's a liability. You see a lot of banks and auto shops that offer their customers free coffee, so their equipment, the coffee maker, is actually a liability. On the other hand, Starbucks sells you that same cup of coffee for $4, which only costs them 40 cents to make, thus making it a great asset for Starbucks. Vehicle. Does your vehicle bring in more money than it's costing you in insurance, maintenance, and payments? Say you bought a $10,000 car and paid $200 monthly with an extra $100 in insurance, as well as maintenance fee of about $300 a month for gas and repairs. But this car is being rented out on Turo and it brings you $2,000 monthly. Then it can be counted as an asset. I hope you now have a better understanding of assets versus liabilities. Everything that is an asset can be considered a liability, vice versa. Is it putting more money in your pocket daily, weekly, monthly, quarterly, or annually? Or does it cost you money to operate, making it a liability? The rich invest mainly in assets while the other 97% of the population invest in liabilities. Let's look at a rich family example. They will own multiple assets and have multiple sources of income. This particular person I know has 20-unit apartment, 8 rental cars, a restaurant business, land of roughly 500 acres of corn, stocks, bonds, and dividends, inventory, non-perishable goods, savings bank account for payroll, which brings them about $200 monthly in interest. Now let's look at a middle-class family and how they spend their money. They will have 1 or 2 sources of income and no assets. The husband, which happens to be in IT, makes roughly $4,500 monthly. The wife, who is a nurse, makes $3,500 monthly, again after taxes. They live in a $500,000 home. They have 2 cars, they have some student loans, they pay for cleaners to come out to clean out their house once a week, so 4 times a month. They pay $100 a month for someone to take care of their lawn. They spend $500 a month on food and $1,000 a month on entertainment. So as you can see, they did make $8,000, which is an enormous amount for a middle-class family, and they spent $7,600, which will leave them with only $400, which carries over as an emergency fund account. As you can see, this is how the low and middle class are living. They spend all their money on liabilities, nothing comes in other than their paycheck, and everything goes out, while the rich have nothing but assets that are working for them. If you like more videos like this, leave a comment on what you wish you knew. Please like, share, and subscribe to our channel for more videos.